We're going to be talking about the future of fintech. Where are we going to be in 2030 or 2050? Will I be able to wink my eye and transfer crypto to paper money through a retina scan? I don't know. Let's find out. Moderating this panel is Misbah Naqvi. She is the general partner and co-founder of I2I Ventures, Pakistan's first female-founded VC fund. She's joined by Omer Khan, who is the founder and CEO of PostX. Omer Khan, Misbah, could you join me on stage? Misbah Naqvi, you have a big task ahead of you. Just have a seat. She's going to be joined by Omer Khan, who is the founder and CEO of PostX, Pakistan's largest e-commerce service provider. Hi, Omer. Welcome to stage. And Jamshed Meherhomji, who is the co-founder of Trellis, a digital affordable housing finance company. Hi, Jamshed. Naureen Hyat, who's the co-founder and CEO of Teys Financial Services and CEO of ZoodPay Pakistan. Arif Lakhani, founder of Kist Bazaar. And Fawad Abdul Kader, country manager of PayMob Pakistan.
So thanks for taking the time to be with us. No pressure to all the panelists. We're the first panel of the morning. And following Dr. Adil Najam is not an easy task. But hopefully, the topic we're going to talk about, which is fintech, the future of fintech in Pakistan should be something that would hopefully keep people's interest. Sahar's done a great job of introducing the panelists, so I'm just going to jump right in. We've often talked about how fintech plays a key role in the development of a country, both in terms of financial inclusion, access to goods and services, but also being able to bring more people into the financial sector and also providing one of the key things that even Dr. Adil Najam talked about, which is access to wealth and well-being. And I think in Pakistan, in this quarter, we've seen that startups that have raised funds, 38 million of that came from the fintechs that raised money this quarter, which is the largest sector in the last few months. Since 2000, fintechs in Pakistan have raised $200 million or so it's not a small amount either. I think Dr. Adil Najam talked about disruption coming with responsibility. And I want to start talking about disruption with our panelists. Hopefully, ye mic set up ho gaye? So I think I want to start with the question of disruption. We often talk about fintech in the context of disruption. And Pakistan is ripe for disruption from that perspective. Obviously, we're also at the conference, which represents that. I think it's important to recognize that fintech is an opportunity not just to make money and have huge commercial gains, but also have huge impact. And I'd love to ask all of the panelists to comment on two things. What are you doing that is disrupting the fintech space in Pakistan? How is your work doing something new in the market? And with that, how are you seeing the incumbents responding, and how do you see that going in the future? So, Omer, we'll start with you and maybe go down the line from there.
Thank you, Misbah. It's really hard for us to see how financial inclusion is going to play out in Pakistan in coming years. But there is one thing for sure that we know, that as long as all the stakeholders who are part of the ecosystem are going to work together, that's the only way we're going to be able to include the unbanked and the people that we are trying to target and trying to include them in the financial system is going to be possible. We as startups, I personally believe that we as startups are too much inclined towards the change, that we have somehow stopped working towards the solutions, and we are chasing the change. We're trying to build the change. In fact, and we have started to believe that if we're able to build the change, it's going to solve the problems. It's going to solve that is the solution of everything. But in reality, it's the other way around. We have to build the solutions that are eventually going to build the change. And that's the exact approach that we have been focusing on from day one. When we started PostX, we looked at the problem, which was around working capital and how e-commerce is struggling to get access to capital. And we didn't try to reinvent logistics or financial products. We just clubbed the two. We saw the product in the financial markets, which was receivable factoring, and then at the same time, we saw logistics, that is the backbone of e-commerce. And for us, the solution was very simple, but solving a very critical problem for e-commerce. And clubbing the two products helped us solve the problem. And now, 13 months later, when you see conventional businesses following the same route, that's one step towards the change that we started 13 months ago, or something that we wanted to work towards. And that's how you work towards the change. You build small solutions, simple solutions for critical challenges or critical problems that are out there for e-commerce platforms or for any market that we're trying to target.
Great, thanks. And how have you seen incumbents in this space kind of take a player like you coming in and bringing in this disruption?
You see, when players like us come in and try to solve certain problems and try to capture the market share, for them there are two options. Either they can start offering the same services as we are right now, or they'll be left behind. So it's not about who's going to win. It's about ecosystem has to win. It's about the end consumer that we're targeting has to win. And now when you see them following the same path, it means that we are able to bring the change. We are able to give access to capital to everybody in the market. And that was the mission on day one. We have to provide the capital. We have to give access to capital for everybody in the market, regardless of the size, regardless how big or small they are, rather than just the chosen few. Mm-hmm. And for startups, it's not about either they're gonna win it or we're gonna win it. It's not about either one of us is gonna come off as a winner and the other one is gonna lose or just fade away. It's about working together, learning from them, because they have been in business for 40 years, 30 years. And for us, there's a lot to learn from there and evolve. And same for them. Rather than just shutting us off, they have to, when you talk about financial institutions, that's different. When you talk about logistics, that's a little bit different. For logistics, they have to evolve as the market is evolving, as the requirements of the market is evolving, because you can't hold back the growing market. And for financial institutions, we don't consider ourselves to be competing with them. In fact, we are a layer ahead of which is allowing them to access the market they have not been able to access for years and years. Mm-hmm. Let it be because of the compliance or risk, but we already are sitting with that market. We are already with that segment which we are serving. And we are in a better position to risk profile those businesses and offer them better services or different services which the banks have not been able to do. So banks have something, or financial institutions have something that we don't have right now. And we have something that they have not been able to access to for last 30 years or 40 years. So in future, the only people or the only startups or the companies that are going to be left behind are the ones who refuse to evolve. Mm-hmm. Other than that, it's a win-win situation for both.
Sure, and I guess that goes for both incumbents as well as the startups. Thank you. Jamshed, what are your thoughts?
Yeah, so I guess just to contextualize, Katalyst is an affordable housing finance company. We focus on providing end-user mortgages. And when we started around 2 years ago, it was on the back of a lot of focus being put towards affordable housing in Pakistan with regulatory changes coming in place to support subsidized financing. And we thought this was a very good opportunity for us to be able to come in and actually disrupt this space and come up with just focusing on low and middle income housing and providing end user mortgages to people. Mortgages in general, I think if you look at it in any part of the world, it's a fairly complex end user financing product to offer, right? You're talking about on average, even in the most developed countries in the world, it takes anywhere between 6 to 8 weeks in order to be able to actually issue a mortgage. You're talking about 15 sub-processes, 75 tasks, 9 different stakeholders, some internal, a lot of them external that you need to engage with. before you can actually get to a final sort of disbursement stage. You're talking about anywhere between 75 to 80 documents that are essentially exchanged between your clients, yourselves, the real estate, the seller, the lawyer, before you can actually physically go and originate a loan. So from our perspective, Trellis has essentially over the last 2 years just been focusing on optimizing this entire workflow, right? It is not easy to be issuing mortgages in any part of the world, let alone with the complexities that come with Pakistan. But in general, I think that's what we've been focusing on. Whether you look at it in terms of the financial innovations that we've looked at, or the operational innovations, or the technical innovations, it's all hyper-focused towards just that one goal of being able to issue loans to low-income and middle-income households in an efficient manner, in a cost-efficient manner, and something which focuses on improving and improving the customer experience. So when I think about, say for example, on the operational side of things, I think this is something which, if you were to appreciate the exchanges that happen between different organizations, let alone within an organization, when you're orchestrating 75 to 80 tasks to be able to actually issue a mortgage, you need to often face off to various external organizations as well. And so one of the a few of the things that we've done is, for example, creating partner portals where verification agents, marketing partners can effectively come into the same task or orchestration process, rather than treating them as external parties. This extended enterprise context that came into the financial sort of world, I think 4 or 5 years ago, is that you don't need to be just efficient within your organization. You need to be thinking about doing the entire origination process efficiently. And so that's something that we've been really focusing on within Trellis. One of the other things that you also need to appreciate is that housing finance is not something that is in isolation. We're connected to 40 to 42 different industries. When you're you have partners that are literally all over the place. You have takedars that you have to work with. You have to work with real estate agent companies, marketing companies. You have people like developers, housing suppliers. Every single type of partner has a different way in which you need to connect to them. So again, with all of the focus on digitization and improving that that entire sort of origination process has actually helped us in terms of being able to produce something which, in our opinion, is not something which is just going to be relevant to Pakistan. This is jurisdiction agnostic. It can also be product agnostic as well. Because all the sort of the work in terms of understanding business processes, understanding business models, creating the risk models on the back of that, that is something that helps us in terms of actually, putting out there essentially a product which we feel to be market leading. I think your point about incumbents, about how do we think about incumbents. From our perspective, probably our largest incumbents are going to be banks, realistically, right? Banks offer housing finance products, so do we. When it comes to incumbents, I would say that there is, we want to think of them as collaborators rather than as competitors, of course. The scale of their balance sheets allow them to be able to lend at in a cost-efficient way from a cost of capital perspective. Where we can obviously add value is in terms of ensuring that we do it in terms of the most efficient way from an origination perspective to minimize costs. But at the end of the day, I think one of the things that we basically went out with last year was, because realizing the fact that we're capital constrained as a newly established financial institution, we were essentially selling our loan packets to the banks. So we would take the clients through those 75, 80 steps that you need to. And when we're at the credit committee level, and we were essentially saying, okay, we're ready to fund this client ourselves, but before we fund this ourselves, we're going to share this with a partner bank. We'll give them a period of 5 to 6 days to see whether, if they would be willing to take the credit risk on this client themselves and put it on their balance sheet, knowing that another financial institution has fully vetted the client end to end. I think there are challenges, of course, in terms of operationalizing, working relationships with large organizations, shifting priorities, shifting focus. But I do think there's a genuine opportunity out there for incumbents and partners, for startups to work together. Because at the end of the day, it's not like we're cannibalizing the market for them. The market is so huge in the context of housing finance, in terms of where we are as a nation, in terms of how many loans that we've actually originated, versus what the norm is in the rest of the world. That if you don't come from generational wealth today in Pakistan, there is no way for you to get onto the property ladder. And that is ultimately what we've been trying to solve.
Great.
Yeah.
Thanks. Naureen?
So I think for us, it's interesting because now we've transitioned into a new company. But, disruption for Tez initially and still now, well, at least for me as a founder, meant that access to finance should be as easy as access to a phone. So that's disruption. And we often talk about what disruption is in fintech, and we often talk about customer journeys. But that really is, there's some substance in that. And so for us, it's always been, and as most of us over here, it's always been about it's about picking up a real life example in a non-digital space and digitizing that journey so easily that it becomes very easily adoptable, by the actual average citizen. And it's about the right product, which is, as Omer mentioned, we're trying to build those, but also about the right customer journey and how that customer journey and that product becomes embedded in the day-to-day life of, the customers that we're trying to serve. Well, I'm not going to talk about what Tez did, a little bit about what Zood is doing. So we are trying to build an ecosystem for lending. So this is a digital lending ecosystem for e-commerce. And what we've seen over the last few years of lending is, it's an art and a science. It's not an easy space in fintech for the various reasons that we are in it for. There are lots of challenges in it. Other than the external challenges, there are lots of internal challenges that come with it. And the biggest takeaway has been that you need to have control over the lending journey. And that control comes with having an ecosystem play, whether it's your own, or whether it comes with building an ecosystem with partners. So what Zood does is, it's got 3 pillars. It's got e-commerce. So we have our own marketplace. And Zood is now operational in 6 countries, and the marketplace is up and running in these different countries. Then it's e-logistics. So e-logistics brings in, the logistics and the last mile delivery elements that actually embed into the e-commerce. And what this all resides on is the lending piece, which is the fintech piece. Now, in order to propel that lending, you need to have control over that entire journey of how that product and the customer moves through, the journey on the marketplace for buying a product, and then, of course, how the logistics piece works, and then ultimately giving out the product. So what we're trying to do is, in the center of this ecosystem is the online merchant, or the SME as we call it. And we're trying to build both the supply and the demand side around that online merchant. And when we talk about supply, it's technically, something like SME inventory financing and working capital finance, where collateralization comes from the products in the warehouses that we have. So that's the control element that we have. But also the ease that we bring, with that, that journey. And then on the supply side is the customer, which actually comes through not only our own marketplace, but also the partnerships that we have with any other online marketplace. And that's where, the element of BNPL for us comes in place. So technically, that's what, we're trying to build here. And I think for all us lenders, there's a lot that goes into it. It's great to talk about impact, and that's why we started this in the first place. But knowing the realities in this space, that's where the disruption comes in. Disrupting the way, the actual the actual opportunity is there. So when you talk about regulators, for example, the space right now, I think we're going to probably talk about this later as well. I'll try to cover it then. Sure. But there's a lot to bring disruption in, not only in the journeys, but also in the mindsets of who's regulating this space. And then, talking about the incumbents, so there's a lot that we now see. When we started back about 7-8 years back, the first thing that I've noticed is a mindset shift. I remember, sitting here in 2019, and Abrar was, moderating that panel, and we were talking about, HPL, and they were, them trying to encourage fintechs, and trying to collaborate with fintechs. It was more of a question mark than, the openness to actually collaborate, because I don't think banks or the incumbents were, mindfully ready for the fact that fintechs can actually bring something of value. For various reasons, But now that shift that we see, definitely incumbents and the banks are much more open to collaborating with fintechs. We are working with them on multiple fronts, not only in providing the ecosystem, but now, we see multiple lenders going into balance sheet sharing models. We see funding coming in. Now we see banks, actually, investing equity into companies. So definitely, there's been a great shift. And I think lending is such a huge space. You've got, it's a huge market. It's over $100 billion lending market in Pakistan. You can't expect one entity, whether it's a fintech or a bank, to cover that market. We need to realize that we need, multiple players to come in and actually serve the market, not only to address the needs, but also to build awareness, because there's so much more that comes with lending. We saw with Easy Pesa, for example.
Yeah.
So I don't want to take too much time.
I'm going to move on, because we've only done 3 people and we are halfway through the...
Yes.
Jahan, next time I'm going to fight for a smaller panel and more double the amount of time. So Arif and Fawad, I'm going to ask you to keep it a little short, because I want to get through to some of the other questions as well. But if you could maybe talk about, how are you disrupting the space that you're in right now, and how are people in the space taking it?
Yeah, so I think everything that I've seen in this country coming out of fintech or from financial institutions, it's targeted towards the 20% of Pakistanis. My ban kebab wala, if he wants to buy a fridge today, because it's his right also to have cold water, there is not a single place where he can walk into, get a plan and buy that fridge. Bank में वो enter नहीं कर सकता क्योंकि उसके कपड़े में से smell आती है. Tech उसको इतना ज़्यादा आता नहीं है कि he can go and he can buy something. He has no credit. He does not have a salary slip, which is a must for 90% of the places. That's how Kiss Bazaar was formed. The idea behind Kiss Bazaar is that it's for everyone. It's for those 80% of people that I feel that are really underserved, and in some ways we've forgotten them. So a common man can go to our site, buy anything he wants on installments, easy installments of 12 months, 18 months, with little or no process involved, and get the product in 24 hours. 11 months, it's been about 11 months since Kiss Bazaar started. We've done about 12,000 sales, so there are 12,000 running customers who are on our site. And I can easily say that at least 70% of those would have had no other option other than to go to a corner store, loan shark, to get their desires fulfilled. Thank you.
Thanks.
Can you guys hear me?
Yes.
Okay. So defining disruption. Disruption is all about changing what's happening today, right? So it's about improving the processes. It's improving the cost of operations. It's about using technology. So that's what fintechs are basically doing, right? Using technology to bring down the operational cost of businesses, providing them more accesses, creating a reach for them. That's all we do. So disruption is more about changing the way that we are operating today. And PayMob, being entrant into Pakistan very recently, we are working in the payment space. And our goal is actually to disrupt the payment landscape in Pakistan. So just to give a very short answer to this is, Pakistan, over all its financial services period, has like 100,000 POS machines out there in the market, 3,000 e-commerce merchants out there. We target to do that in the next 2 years, right? How we target to do that is, of course, through agility and the technology stack that we have, so that we can actually, so we're not, and these 100,000 POS machines are at around less than 40,000 merchants out there. So the financial services landscape has been there for a certain niche. What fintechs and what disruption needs to come in is to actually go in deeper into the market and digitize the more than 5 million SMEs that you have out there, capture the market that's untapped. We have done this in Egypt, by the way. So out of the 100,000 merchants that we have in Egypt, 90% of those merchants are first-time merchants. They never used a digital payment method before that. And in order to do that, you just need two things. One is a mindset that you're basically going to go after these people and be agile, not to just say that, okay, I'm giving this, just take this. I have to understand what is their need. It has to replace cash. It has to be as simple as just what the cash dealing is today. If you make it very complicated for the market to adopt, it's never going to happen. If you make it more expensive for the market to adopt, it's never going to happen. So disruption, in my opinion, is more about what's happening today. Do it in a better way from every aspect, and you'll disrupt the market.
Right.
The second aspect of this, which you talked about, incumbents, it cannot be done without them, right? So there was a debate, I think, 3-4 years back when fintech was sort of a new thing in Pakistan, whether fintechs will disrupt the incumbents, and we have all come to realize. So it's not just the fintechs or the incumbents. I think both the parties have come to realize that we cannot survive without each other, right? Right now, PayMob works with 3 acquiring banks in Egypt. We work with an acquiring bank in Pakistan. We cannot function without them, right? Because there's settlements to happen. There's the acquiring licenses that are with the banks. So I just feel that over years, everybody has matured enough to understand that we cannot function without each other. And it's like Naureen said and other panelists said, I think now the doors are open, everybody is talking, everybody is investing. Most of the large banks have an investment arm into fintechs,
Sure.
and that shows their openness.
Yeah, and I think we're also at that stage where, like you said, initially maybe people felt defensive, but now there's a realization that the opportunity is so huge and that there are different roles that different people can play, whether it's the fintechs or the banks or other financial institutions. One of the things I'd like to dig into a little bit, and maybe I'll start with you, Arif, is this question of risk management. I think in markets like Pakistan, which are emerging, we often hear players, coming in, starting off with new credit models. In Pakistan, credit data is not easily available. And generally, this question around is risk management or a lack of access to credit data, does it become a gating factor for fintechs to thrive and for this ecosystem to continue to grow? And I have aspects of that question for the other panelists as well, but since you work in this space, which is wholly and centrally buy now, pay later, and buy now, pay later has been talked about quite a bit globally and as well as in Pakistan, how are you looking at risk mitigation, and what are the kind of things that you're doing to adapt for the market that you're operating in and yet also manage risk?
So, buy now, pay later. Buy now, pay later is this modern term for something that's been happening in developing countries for 5,000 years. We started doing this in 1995. We had these corner stores. We would sell stuff on installments. We built a database. And yeah, now we're a little bit more luckier. When we went with Kis Bazaar, we had 250,000 people that had dealt with us, so we knew everything about them. But I think there's a little difference between when you compare a BNPL in Pakistan to the likes of Klarna or Afterpay. So their model is very different. If someone wants to do BNPL or any kind of financing here to a common man, they need to know the pulse. Like, you can't be sitting in defense and be able to figure out कि मच्छर colony में क्या होगा, because that's Pakistan. यहाँ जब हम बैठे हैं, this is not Pakistan, right? So I think if you understand the common mentality, which is that there is no credit in this country, even for the rich, there is no credit in the country, but people are scared of people. People are scared of their reputation. So what we do is we take social guarantors. So for every one person that comes to us, they come with 2 guarantors, which could be anyone in their mohallas, anyone who lives around them. And because of the obligation of that particular person, they make sure that they pay on time. So you have to customize it as per the country. I know, I mean, we've looked at the model in Egypt as well. Egypt goes in a very similar model, that they believe that you might not be scared by getting a call from the lender, but you'll get scared if your wife's friend calls you and says, why didn't you pay that person on time? So that's what we do. Since day one, we take 2 guarantors, and we don't even look at the applicant. Applicant doesn't matter, could be anyone. Those 2 guarantors have to be anyone in their area who knows them. So here we have 3 people involved, and everyone's going to safeguard each other's interest. Very similar to what Grameen Bank does.
Great. Jamshed, in the housing finance space, I mean, like you were talking about this big opportunity to bring more people into giving them access to owning a home. And this is something that Pakistanis have not had access to in a large way so far. How are you looking at risk mitigation in this space, and how are you building some of those credit models that will allow you to make good bets as well?
Yeah. I remember when I moved back to Pakistan, I think 2 years ago, and I was telling people I was going to give people money to be able to actually buy a house. They're like, "Bhag jayenge paise leke, what are you thinking? Like, are you crazy?" It's, you know, I think over the last 2 years, I've actually come to the conclusion that, okay, housing finance, yes, they're bigger checks that you need to cut. Every time you are essentially giving out a loan to someone, even if it's for low-income housing, you know, typically it tends to be, if you're buying a new house, it's 30 lakh rupees, that's like $15,000. If you're going to middle income, you know, that's going to go up to $180,000 every loan. Like, you know, you give us $2 million, we can deploy that in, you know, 10 days, 15 days. But what we need to do in order to make sure that that capital is essentially given out in a controlled manner, in an efficient manner, and that's something that we are very sure that, despite the fact that the lending is, you know, 100% secured, backed by the value of the collateral, that we never get into that situation where we have to enforce that, that liquidation. So from our perspective, when it comes to the initial bit, where it's assessing the credit worthiness of the client, you know, whether it's the applicant or the co-applicant, and you're looking at their ability or willingness to pay, especially in the context of low-income households or middle-income households, we had to basically come up with our own proprietary credit scoring model where, through a series of questions that we would ask them about their income and expenses, their assets and liabilities, their behavioral patterns, questions about what their average sort of projection looks like in their lives in the next 5 to 10 years. And then based on all of these responses, we essentially came up with our own way to be able to understand whether this client could qualify for lending or not. You know, whether if someone is, for example, already living in a rented household and has the discipline to be able to make regular, recurring payments, from our perspective, that deserves to be, given some more weighting. We've seen in different parts of the world that if a female is essentially the head of the household, that they are actually more disciplined to be able to actually pay back. So all of these responses that used to come back from the client's forms are used to actually come up with our own credit scoring model. Of course, I think coupled with that, we do our standard checks in terms of credit bureaus and
Sure.
And all of that. But most of the time, these are credit virgin clients that we work with. And then from our perspective, when it comes to the actual risk verification stage, so this is where you have to do a lot of physical verifications on the ground. So, similar to I think what we were saying about, doing home and neighborhood checks to understand where the client or the household is currently living, what is their social situation in relation to their neighbors, what sort of perception does the local mosque or the local grocer have in relation to that family, any issues or hiccups. Those are things that are picked up at the home and neighborhood stage. Then the income verification is, of course, I think where we get a little bit more technical. We obviously go on site to understand the client's income and expense patterns. Of course, if you're salaried and if you're formal, then it's much easier to be able to do your verifications versus if you're informal, if you're a business owner, if you're contractual employee. But that's the whole reason why Trellis basically came up with its own credit proprietary model, is to be able to cater to all of these different households in the low income sector. Then when you come to the property side of things, right, you're essentially collateralizing or securitizing yourself versus the value of the property. So we have, these valuation agents that are approved that go into the market and actually do the assessments of those properties, of the neighborhood from an ESG perspective, making sure that these units are actually built legally. They're not, they're taking into account good practices, that they're habitable. And then all of these things actually basically culminate into our own data models. So right. One aspect of it is going into the field and actually, doing these verifications. You can do it on, GPS-enabled forms to make sure that you're controlling any sort of fraud risk, etc. There's another aspect of it, which is making sure that your decisions are data-driven, right? So this is where we basically then start scraping hundreds and thousands of data points on a daily basis in terms of property values all across the country. So we know, in relation to that one property that's going to be financed, what do the other properties look like in those areas? If there's a significant deviation with regards to what's been quoted, then that's where we actually, flag something as an issue. We do the same on the construction side of things as well, right? There's that material development risk in Pakistan. Your developer comes, he takes your money, and then he basically runs away. So in order to do that, we ask the developers to actually provide, very technical installment plans or BOQ schedules. We vet them versus, again, data-driven decisions around what's the actual, cost per square foot these days in terms of these different materials. So all of these things combined ultimately is what we present at the credit committee level before we decide whether to lend or not. And then we feel secure that once we've done those verifications, the legal title, all of these other checks, then we can give out those big checks. $200,000 every loan is not, it's hard for a startup to do, but I mean that's the average price of a house in tier 1 city in Pakistan these days. So that's our story, I think, on the risk side.
So Fawad, as a player that's been regional and looking at Pakistan, what are some of the things when you guys looked at the country? Obviously, we know why the market is attractive. We know what this opportunity is representing. But what are some of the things that you were able to see that were parallels between, let's say, Egypt and other markets where you are in Pakistan, and how did that help you hit the ground running in the context of coming in as a fintech player in Pakistan? And I'm also would love for you to share that so that people who are here that maybe from the region that are interested in looking at Pakistan, what are some of the frameworks for them to evaluate our market versus other markets in the region?
Okay, so the key word is opportunity, frankly. So Egypt was like 3 years back, it was exactly at the position where Pakistan is today. In Egypt, we had around 80,000 POS machines. Today, in Egypt, after 3 years, the POS machine, there are around 650,000 POS machines there. So it's multiplied like 7 times in the last 3 years. The market is very similar. It's half the population of Pakistan, but it's very similar market. So when we looked at Pakistan, frankly, we saw a market that's ripe. Actually, a lot of players in the market have done great work in order to create that awareness in the market, where the Pakistan market is currently ripe for that kind of growth, right? A 4x or 5x growth in the next 2-3 years. We over here want to contribute. So all the players here are potential partners in this, right? So the idea is for us to lay down the infrastructure, the technology infrastructure that actually connects the lenders to the lendee, right? Because it's very important for somebody to have that mass scale in the market of the number of merchants it has, the businesses that it can tap, and connect it to entities that can actually lend or that have deposits from which they can pay. So we are the middleware which actually connects this, right? And we felt that Pakistan is actually right now in a position where we can come in and invest and very quickly grow, because in a population of 220 million, you have like 100,000 POS machines, like I just mentioned, which is like 2,200 POS machine, one POS machine per 2,200 people. Now, in a country like Iran, that's one POS machine per 10 people, right? 80 million people and 8 million POS machines there, right? I think there are things to be done in order to go there, and we can discuss that if time allows. But I think incentivization needs to happen in the market, and that's very critical. Incentivization when it comes to taxation, incentivization when it comes to a use case which would actually drive the nation. So just sharing this example from Iran, or maybe I can share about Egypt as well. So in Egypt, the regulator actually started this with pitching in 100,000 POS machines for the market, right? And you just had to apply and get those POS machines and just put them in, right? Of course, you have to manage and operate them, and there is a cost to it, but then it becomes, so certain incentivizations have to happen in Pakistan also, and we are at the cusp of making that breakthrough, and we now need to have those. In Iran, you don't get your tax credit back if it is not in a digital form, right? So that incentivized everybody to actually go digital, because then you get your tax credit back. So the thing is, incentivization, simple incentivizations like this, you need to find what is your use case that people will jump onto to get themselves digitized. And this is something that we need to think about. One more thing, just regarding data. I think we are very closed as far as data sharing is concerned as a country. I'm sure the lenders have a horrible time collecting that data. There's so much data out there, and that data is not being shared, right? Some of these entities don't even know what they're sitting on. They're sitting on a gold mine, right? But they don't realize that. They have never worked on digitization. So there's a huge opportunity, actually, to actually consolidate this data. Because until and unless we do that, we as a country would always struggle with lending, which is, by the way, the most important pillar to digitization.
It's also the most lucrative out of all the financial services you could be engaged in. So you talked about incentivization. I think the government has taken certain measures to try and electronify, digitize at the merchant's end. There has been some pushback. If we talk about a wish list, or let's say if each of you were to have like a magic wand, and you had one wish today, and we'll go rapid fire. Like, I just want quick answers. What is it do you think that you would want? What would be on the top of that wish list? It could be at a policy level. It could be from somebody else in the space. It could be from a customer level. What is that one thing that you think would be a game changer in your specific space? Omer, we'll start with you.
I think the policies are there. Regulators are working really hard and trying to facilitate fintechs. But the gap is where we want the regulator to enforce those policies as well. Because when you talk about financial institutions, they are very risk averse. And for us to take advantage of those policies, it's very important for them as a regulator to enforce those policies through those financial institutions so that we can take advantage of them.
Okay, great. Jamshed?
From my interaction with the regulators in Pakistan, I would say that there needs to be a little bit of focus on self-governance to start with, focusing on improving their own, processes within the, in terms of how they face off to the different stakeholders. I think there's a lot of delays and a lot of issues that we end up facing as a result of inefficiencies in terms of how they interact as an organization themselves. And then also in terms of how they interact with other peer regulators, so between the SECP and the SPP, I think a lot of times, things get delayed for us as a housing finance company being regulated by the SECP, because of the majority of the other execution agents are all banks and regulated by the state bank. In terms of aspirational sort of policies, I think you mentioned data sharing in the context of data residency, data hosting, third-party data sharing regulations. Also in terms of just, really forcing, as you said, those specific, programs that are focused on SDG goals and making sure that those are actually being enacted by all the different execution agents. I think that is super important. Yeah.
So we need to disrupt the government
100%.
as well.
I'm ready.
Or at least RegTech, because RegTech is actually often seen as an
Absolutely.
opportunity in a lot of other markets also, where they are
Absolutely.
providing technology to the regulators to be perhaps stay on top of things and not have things fall through the cracks.
Yep.
Noreen, what would be on your wish list?
That's a tough one. These guys have covered most, but so yeah, I think synchronized policies. Many times the policies come in from one particular, authority, and it's usually disjunct. For example, if digitization is required and you require, your NADRA APIs to be provided to, all the lenders, that's not really done. So while your SECP and SPP is encouraging that, NADRA is not providing it, or the taxation authorities are not ready for it. So I'd say policies that are in sync for all the unit economics that actually flow into the lending model. But that's a long list. So I'll in the best interest of time, I'll skip that.
Yeah, I think the regulator needs to go to the banks and tell the banks that you can't take money from people and give it to the government. More than 50% of deposits that you and I put in the bank goes back to the government. It should be going back to us. It should be going to the FinTech panel here, so they could actually help you.
It's a great point.
Okay, so 4 points here. Would not take a lot of time, but would want to address this. One is we have like different regulators in the country. So when we talk about FinTech, it's FBR is a regulator, SECP is a regulator, the State Bank is a regulator. I think State Bank being the most proactive, frankly. We don't want to over-regulate as well. That's very important. So that's the first point, right? In majority countries where innovations have happened, regulations have always followed innovation. It's never been the regulation coming in. It's probably Pakistan where regulation comes first and then the innovation happens. So that's one. Don't over-regulate. So State Bank has been really proactive. They have been really supportive. But I feel that the other regulators need to follow suit. I think, like Naureen said, everything needs to align itself. Taxation policies today do not support digitization. We have been I'm also part of an association which we call Pakistan Fintech Association. We have been educating incentivization of tax, right? More recently, since we've given up on that, we are saying disincentivization of cash, right? So at least do that, right? Cash should be disincentivized. So that's very important. In our tax laws today, digital transactions are not covered, right? So that needs to come in. So we talk about, we sit over here, we talk about digital payments and how it is important for the country. If you go into our tax laws, all of us, I'm sure, struggle in finding the right combination of laws that apply to us. Thirdly, is still in Pakistan. We talk about direct foreign investment. Direct foreign investment, I can tell you the people who raise do not bring it in. Why they don't bring it in, we have to analyze that, right? Why do they have to keep their money outside and only bring in money which they need for their operations? We have to analyze this, right? We are not creating an environment where people would transfer all their dollars, all their investments into Pakistan. And I think that's, again, a policy matter that we need to address. So I think we need to think about all these things which are very apparent. People don't really talk about them a lot, but these are things which are hurting the industry and its growth. So we coming into Pakistan, frankly speaking, is because of the opportunity. But as a country, we need to understand that we need to create that environment for more people to come in.
Sure. No, thank you. We just have under a minute left, but there is one question that I wanted to ask specifically Omer and Naureen, because you actually represent two companies that have seen an exit and an acquisition, which is unusual in our market, and a lot of people are looking at Pakistan to see when our exit is going to happen, when our acquisition is going to happen. So for founders over here that are building companies, whether in fintech or outside, I'd love for you both to share your perspectives. Noreen, maybe start with you, since Stays got acquired by ZootPay and obviously has now merged. But for you, what were some of the steps that you took to get there? How did it happen? What are some lessons that you could share with founders? And then, Omer, I'll come to you as a company that actually acquired another player in the space and an incumbent. Would love for you to share how you thought about that opportunity. And if you have any suggestions for founders over here that would like themselves to be acquired or would like to acquire other companies in the space. And then we'll end on that note. We're at 0 seconds, but I'll let you.
I'll really try to make that brief. So yeah, I see. No one is, I wasn't at least prepared for an acquisition. And with as a founder, I don't even know whether the end goal should be an exit. I think for us at least, the goal was always to build value. And if someone else saw value in that value, that's where that success came in. So exits are to be thought about by investors, not by founders. That's one thing that I took away from it. One other thing is that the companies are not sold, they're bought. And they're bought for the value that they create. So I believe what we built over these past 5-6 years, that's something that Zoot saw value in. And while we were there were other offers on the table. And it was a process of orchestration. So, it was an orchestration process. There's no one person or one entity that's actually responsible for it. From our board to our investors, most importantly, our team. There was an entire process that went into orchestrating that deal. And then, of course, it was the investors, their board, their teams, the people who are doing their due diligence. So everyone is equally important in orchestrating an exit. So for us, we were very fortunate in the timing of how things came through. And yeah, there's a lot that we can share on how interesting that journey was. We're still going through that journey. And I think what marks that difference in why and how companies get bought is, other than the value, the culture that you bring in, particularly the team. So for us, what really mattered the most was that Zoot actually took in an entire team. And that really mattered for us because of many reasons, And it was really interesting because when we were going through that process, the first people that we spoke to, of course, was our team, and to really see how they were going to take in that prospect of an exit. And yeah, it was an interesting few months, and it ended up like this. But yeah, I think what I'd like to say to all the founders here, whatever you set into your company, just make sure that you get into it for the right purpose. And if an exit is the purpose for you, I don't think there's anything wrong in it, but focus on building value. Focus on getting into, starting anything because there's a purpose behind it, not because you want others to see a purpose that they're envisioning for you. This is something that we live, eat, breathe every day, and it can't come in unless you passionately feel for it, and that value only then culminates when you actually think about that way. So yeah, that's what I'll have to.
Thanks, and congratulations. So Omer, Naureen said companies are bought, not sold. What was your thought process in buying Call Courier, an incumbent in this space?
Why you do what you do and what motivates you. When we started this company, we didn't start this to cash out or to do an IPO and make money. For us, we wanted to build solutions that are going to help us build a business, and a business that is going to help us build a legacy. And that's what motivates us. That's what we fight for. We're fighting to build a business that is going to build a legacy. And when you talk about acquisitions, or let it be somebody acquiring you or you acquiring them, you have to see how that adds value to your vision, to your mission. Is that really going to help you achieve your goals? Because acquisitions are not about making money or about buying growth. It's about getting to where you want to be. And if, as a founder, if you see somebody with bigger ambitions, bigger goals, bigger dreams, and they welcome you to be part of their team to achieve their goals and your goals at the same time, then it makes sense. Because money is a byproduct. And when you're able to achieve your goals, if you're able to build the legacy, that's what matters. people will remember the legacy. No matter how much money you make out of acquisition, people will forget.
Sure. I mean, money does help too. But no, but thank you. On that note, we're going to end. But before we end, can we please have a round of applause for our interpreters? This gentleman and lady before that. Thank you. Thanks very much. Thanks to our panel. Jahan, I'm going to fight with you. I don't know where you are. Next time, we need an hour and a half if we're going to have 5 people, because there's a lot more we could have dug into. But thanks, everyone. Thanks for your time.